Did you know that a staggering 70% of traders lose money in futures and options trading? This startling statistic highlights the crucial need to understand the risks involved before diving headfirst into these complex financial instruments. Futures and options offer the potential for significant returns, but they also come with substantial risk. Many traders are lured by the promise of quick profits without fully grasping the intricacies of these markets. This lack of understanding often leads to devastating losses. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specific date in the future. Options, on the other hand, grant the holder the right but not the obligation to buy or sell an asset at a specified price within a set time frame. Both futures and options are powerful tools for hedging against risk and speculating on price movements. However, their complexity and leverage can magnify losses if not managed effectively. Futures and options are derivative instruments, meaning their value is derived from an underlying asset. This asset could be anything from commodities like gold and oil to financial instruments like stocks and currencies. Traders use futures and options to speculate on the future price movements of these assets. For example, a trader might buy a futures contract for crude oil if they anticipate a rise in oil prices. Conversely, they might sell a futures contract if they expect a decline. Options trading introduces another layer of complexity. A call option gives the holder the right to buy an asset at a specific price, known as the strike price, by a certain date, while a put option allows the holder to sell the asset at the strike price by a certain date. Traders buy call options when they are bullish on an asset's price, and put options when they are bearish. One common misconception about futures and options is that they are inherently riskier than traditional stock trading. While it is true that futures and options trading can result in larger losses due to leverage, it is not inherently riskier. The level of risk is determined by the trader's understanding of the instruments, their risk management strategy, and their ability to control their emotions. Another misconception is that futures and options are only for sophisticated investors. While it's true that these instruments require a deeper understanding than basic stock trading, anyone willing to put in the time and effort can learn to trade them effectively. The key is to start small, educate yourself thoroughly, and gradually increase your exposure as your knowledge and experience grow. To trade futures and options successfully, it is crucial to understand the various risks involved. Market risk, inherent in all forms of trading, refers to the potential for losses due to adverse price movements. Liquidity risk, particularly relevant in options trading, arises from the possibility of being unable to exit a position at a desirable price due to a lack of buyers or sellers. Credit risk is the risk that the counterparty to a trade will default on their obligation. To mitigate these risks, traders employ various strategies, including diversification, stop-loss orders, and thorough research. Understanding and managing these risks is paramount to long-term success in futures and options trading.